One of the biggest lies banks tell us is that our money grows in our bank accounts. The truth is that while money may increase in numerical value due to interest, it doesn't grow in real terms or in value, especially considering the impact of inflation. With inflation soaring through the roof and bank interest rates lagging way behind, keeping cash in the bank can actually burn a hole in your pocket. In this video, we will share 6 assets that can help you prevent this wealth erosion and enable you to create intergenerational wealth. Number 1. God's money: gold, silver, and platinum. One of the biggest reasons why money is considered valuable is because it is used to store value for the future. However, governments today print more and more money to finance their deficits. Therefore, you never know when that piece of paper you call the dollar will become worthless. This is why financial gurus recommend investing in something valuable that is scarce and can't easily be created. This is the biggest reason why the rich have a portion of their portfolio always reserved for precious metals. Precious metals such as gold, silver, and platinum will always rise in value when inflation rips through the ceiling. Before the 1950s, an ounce of gold could be bought for $400. In 2023, the same ounce is priced above $2,000. According to Prime XB's gold forecasts, this is supposed to go up to $10,000 by 2032. That is, in about 10 years, your gold investments will be 5 times what they are now. So while cash keeps going down, gold keeps going up. Similarly, other precious metals are also better than holding cash in the bank. If you are wondering how to gain gold exposure to your portfolio without buying physical gold, you can invest in gold ETFs. Gold ETFs are highly affordable investment vehicles that give you returns based on gold price movements without you having to hold physical gold. Number 2. Industrial commodities: raw materials. While scarcity is one reason why precious metals are considered valuable, they also possess natural utility value. This makes them indispensable as industrial commodities. For example, silver is used in the production of electronics, medical equipment, nuclear reactors, and more. Similarly, other metals like cobalt, nickel, and copper have high industrial demand due to their unique properties that are not easily replicated by alternative materials. To provide a clearer picture, since 2020, the demand for cobalt has skyrocketed. The primary reason is its crucial use in producing batteries for electric vehicles. As a result, its prices have risen from US $20,000 per ton in 2012 to US $40,000 in 2022, marking a 100% increase in just 10 years. Therefore, having exposure to such raw materials can significantly boost your portfolio during high-demand phases. However, not everyone can invest large sums of money in acquiring raw materials, nor can they physically store them or find the right buyers. Therefore, investing in stocks of mining companies like Rio Tinto, mining-focused mutual funds, or even derivatives such as futures and options are all great ways to gain such exposure. Number 3. Safe haven currencies. In the current world of fiat currencies, where no currency is backed by gold, geopolitical stability is a crucial factor to consider when investing your money. This is why the rich often choose to keep their money in Swiss banks. Switzerland, known for having one of the world's strongest economic systems, offers a much more stable geopolitical environment. As a result, the Swiss franc is considered a safe haven asset during times of turmoil and instability. We have witnessed this phenomenon repeatedly, such as during the Eurozone debt crisis in 2009 and the global financial crisis in 2008. Significant funds flowed into Switzerland from affected countries to safeguard wealth from currency depreciation and erosion. Additionally, the Swiss franc serves as a valuable alternative to the US dollar for international trade. For instance, during the recent Russia-Ukraine crisis, when the US imposed sanctions on the Russian energy trade, Russia executed trades in Swiss francs. Such events trigger a surge in demand for the Swiss franc, leading to its tremendous appreciation against all other currencies. In early 2023, 1 Swiss franc was equivalent to $1.1074 US, resulting in overnight wealth multiplication for Swiss franc holders. Therefore, superior currencies like the Swiss franc, British pound, and Chinese yuan are considered great stores of value. However, since not everyone can open Swiss bank accounts, currency ETFs and forex brokers, such as Forex.com, provide opportunities for smaller investors to gain exposure to currencies with as little as $100. Number 4. Sovereign guarantee. Have you ever closely examined the dollar? It bears the words, This note is legal tender for all debts, public and private. Have you ever wondered what it means? Since 1971, when President Nixon abolished the gold standard, the dollar became the legal tender by U.S. law. This gave it value as a medium of exchange, and we started considering it an acceptable form of repayment for any good or service. Although no fiat currency in the world is backed by gold or any other physical asset, they are still considered to be backed by the full faith and credit of the government. In simpler terms, the stability of your money is directly tied to the stability of the government that backs it. This is why investing in sovereign guarantees is considered a valuable store of value. The government of any nation is typically the last to default. If the government defaults, the entire nation defaults. Strong governments will strive to prevent such an outcome. One of the safest ways to invest in sovereign guarantees is through government securities or GSECs. However, it is advisable to invest only in stable government GSECs with investment-grade credit ratings. Remember the sovereign debt crisis in Greece in 2009, where the IMF, Eurogroup, and ECB had to repeatedly bail out the country from its debt. Therefore, the global strength of a government should always be taken into account when investing in GSECs. In the U.S., you can invest in treasury bills, notes, and bonds to gain exposure to sovereign guarantees. These instruments offer better returns than keeping money in the bank, and they are backed by the strength of the U.S. government in the global economy. Small investors can purchase treasury securities directly from the government through the Treasury Direct portal or from the secondary market. Number 5. Value stocks and mutual funds. Treasury investments do indeed offer lower returns compared to stocks, but they also come with lower risk. While low risk is an important criterion for risk-averse investors, higher returns are sought by almost all investors, and stocks provide a great opportunity to achieve that. However, it's worth noting that not all stocks carry the same level of risk. The stock market can be broadly divided into two types of stocks: value stocks and growth stocks. Growth stocks, especially in the technology sector, tend to be riskier because they involve ideas and technologies that have a higher potential for failure. On the other hand, value stocks, such as companies dealing in industrial metals like Nucor, are considered less risky due to the established demand for such materials in the foreseeable future. Value stocks with strong fundamentals not only provide steady and stable price appreciation, but also offer stable dividends. Researching the fundamentals of each and every value stock can be time-consuming and cumbersome for average investors. Therefore, dividend-focused mutual funds, like the Vanguard High Dividend Yield Index Fund Admiral shares, which have a stable history of paying dividends, are ideal and affordable investment vehicles for retail investors. These funds provide exposure to a diversified portfolio of dividend-paying stocks, saving investors the effort of researching individual stocks while still offering the potential for higher returns compared to treasury investments. Number 6. Land and real estate. Accountants consider land as a non-depreciable asset for a valid reason. It is scarce and always in demand. Throughout history, land has been one of the most valuable resources in the world. We need land for homes, schools, factories, agriculture, commercial spaces, and more. With a growing human population, the demand for land will never diminish. Similarly, residential homes, office spaces, and commercial properties built on land are also consistently in demand. Therefore, both land and real estate serve as excellent inflation hedges in an investment portfolio. To provide some numbers, a Bloomberg study indicates that housing prices tripled between 1992 and the 2020s, despite a significant dip during the 2008 housing bubble. This demonstrates the value and potential returns associated with real estate. However, many small investors tend to consider real estate much later in their lives, primarily in terms of the house they live in. While owning a fully paid-up home is a worthwhile net worth goal for individuals in their 40s, having exposure to the retail property market is recommended at every age. Contrary to common belief, you don't need a large amount of money to gain real estate exposure. You can invest in real estate investment trusts, REITs, which are similar to mutual funds but specifically focused on real estate. One of the most popular REITs in the U.S. is Ventas Incorporated, VTR, which invests in healthcare real estate, including senior housing, research facilities, hospitals, and more. Alternatively, you can consider borrowing to own rental properties, with the rent covering expenses and mortgage payments while also providing profits. In summary, land and real estate hold significant value and serve as valuable addition to an investment portfolio. Whether through REITs or owning rental properties, Real estate exposure can be achieved without necessarily requiring a substantial amount of money up front.